How the good old IAS2 is examined at SBR and Advanced Audit and Assurance of ACCA and CR of the ICAEW exams. What are they? What's included and why? How do you arrive at the correct cost for inventories as per IAS2? How does this standard interact with other accounting standards, such as impairment, IAS 36? And how are inventories accounted for when using hedge accounting? Yes, hedge accounting. You will also learn a bit about IAS 41, and if I do not mention consolidated accounts, it would simply be unfair. So I'm going to revise the accounting treatment of inventories in the consolidated SFP and cash flow. Hello, and welcome to the second episode. My name is Nasser, and I'm delighted to be with you here today. I can't wait to see you all in episode 100. We can certainly do that episode 100. I understand how complicated this seemingly minor topic such as IAS2 can be in SBR, Advanced Audit and Assurance and CR exams, but don't worry, we will get through this together. And who knows, by the end of this video, you might find accounting, dare I say, fun. Okay, I went too far. Anyway, I hope IAS2 will be more manageable whenever you see them in your exams. So grab a cup of coffee and let's get started. So let's cover all of these topics. We'll have to start a support group for people who are tragically uninformed about these very important topics at this advanced level. So let's begin. Let's begin by talking about what are they. You can say that inventories are items that they are acquired with the intention of being used in the business or to be sold at some point in time. This suggests that inventories could be anything, not just stock of goods. The different shades of inventories are: number one, in the form of raw material or supplies to be consumed in the production process or the rendering of services. In other words, we are talking about raw material. The second form could be inventories are those assets which are in the process of production for sale. In other words, we are talking about work in progress. And the last one, inventories are the assets which are held for sale in the ordinary course of business. In other words, we are talking about finished goods. Now, you have to pay close attention to the ordinary course of business point. In its very basic form, inventory could be anything the business intend to use or sell in the ordinary course of business process. Sometimes the examiner at SBR and CR of ICAEW typically present a scenario involving sale of an unusual item such as property, plant and equipment, or an intangible asset such as patent, such as licenses, and for some reason the proceeds are allocated, accounted for as revenue under IFRS 15. So you have to consider whether buying and selling of that property, plant, equipment or intangible is indeed part of the ordinary course of business. If it is not, after reading the scenario, after reading the context, if it is not, then the sale proceed should not be included in the revenue. And that's why you have to read the question very carefully and use the professional skepticism like a food critic evaluating a dish. It helps you see beyond the surface and uncover the authentic flavor, i.e. the inappropriate accounting treatment. So please pay particular attention to the nature of the business. Now let's a little bit of side note about agriculture properties. IAS 41. Farm biological assets like cows, chicken, goats, and even hard-working bees and other pollinators are not for sale. Instead, biological assets help us in growing delicious crops and raising high-quality livestock. Biological assets should be kept on the farm, not on the market for trading. And it is for this reason that they are valued under IAS 41 principles. Biological assets are measured at fair value less selling costs, and any changes in the fair value are recognized in the profit and loss under IAS 41. Now, I know, I digress. I'm returning back to IAS 2 after a brief digression. So, assume biological asset or biological products are held as inventory in the form of raw material, work in progress or finished goods for sale. They will be classified as inventory then under IAS 2 in that case. So once again, it is possible. It is possible, especially at SBR. The examiner might be interested in a little bit of discussion, so be ready for that. Now, let's turn to the idea of what is included in the cost of inventories. The cost of inventory includes all direct costs of getting the item or product to its current condition and location, the golden principle. This is also known as directly attributable costs. Fixed production costs. Fixed production costs are allocated to each production units based on the actual production level. So you should be ready for that kind of calculation. It is very, very common at corporate reporting exam, not very common at the SBR, but you never know. So please read the question carefully. And whenever you see the following items, please do not add them to the cost of the inventory. You have to be excluding the following items. Number one is the abnormal losses. Okay, number one is the abnormal losses. So if you see any abnormal losses lurking around, know they are being well taken care of in the other operating expenses. These abnormal losses relating to wasted material, labor, or any other production costs do not help to bring the inventories to their present location and condition, and that is the logic basically why they're not part of the cost of sales and instead they're treated in the other operating expenses. So please do bear this in mind. Now is storage cost. Unless those costs are necessary for the production process before a further production stage, then that can be included. Otherwise, in most cases, they are not helping. They are not treated as directly attributable costs, and hence they are excluded. Also, you have the administrative overheads. They do not contribute to bring the inventories to its present condition and location, and that's why they are also excluded. Also, whenever you see some selling costs, please bear in mind not to include that as part of the cost of the inventory. So that's done for the selling cost. But next one is the borrowing cost. What about the borrowing cost? Borrowing costs may also be capitalized in certain situations, i.e. they are added as part of the cost of the inventories if it takes a significant amount of time to prepare for their intended use or sale. For example, raw material or supplies are bought or made and kept for a long period of time before they are used in the manufacturing or to be sold. How to value inventories at the end of the year, the last topic. So the inventories are usually valued at the lower of cost and net realizable value. We all know that from the very, very first class. And cost is usually determined using FIFO or average method. So if the cost of an item at the end of the year is 100 per unit and its net realizable value is 120, then the inventory should be valued at 100 being the lower number. Of course, we do know that. And this inventory is listed as a current asset, of course, on a company's SFP because it is expected to be sold or used within a year or the company's operating cycle, whichever is longer. So you must have to pay particular attention to this operating cycle. This could be important at the SBR. And now let's turn our attention to the fair value hedge accounting. I don't know about you, but I love hedge accounting, particularly fair value hedge. I like fair value hedge because I don't have to remember all the standards that might apply to various assets and liabilities. I only need to remember hedge accounting in that case, which is easier to remember. I hope you would agree with me because it is so simple. In a fair value hedge, you must disregard the relevant accounting standard for the item and remeasure and update the item. You are finished once you have reported the gain or loss in the profit and loss account. Don't be concerned about the IAS2, whatever IAS2 is saying, and therefore you have to be overriding the IAS2. So even though IAS2 talks about lower of cost and net realizable value, the fair value of the inventory, which is going to be the hedged item, should be kept up to date at 120. Hedge accounting usually overrides the relevant accounting standards when using fair value hedge accounting. And what about the impairment? In case of impairment, you have to be writing down the inventories to its net realizable value. An impairment loss is usually usually recognized in the profit and loss account. Oh, hey, just a quick heads up. If you see any reversal popping up because of an increase in the net realizable value, know that this will reduce the cost of sales in the period they appear. So please do bear this in mind. Keep an eye out for signs of impairment or an overstatement of inventory in a question. It's a usual trick in the exams. Otherwise, you risk overstating your profits and assets and losing some easy marks. Avoid allocating impairment losses to inventories if you are wondering why. The answer is that inventories are usually valued at their recoverable amounts in the exam question anyway. But again, the examiner mentioned this fact, but generally without referring to the inventory. So now let's talk about the treatment in the consolidated financial statements and the deferred tax. Due to provision for unrealized profits, there will be deferred tax implications. The carrying amount will be lower than the tax base, giving rise to deferred tax asset. Let's assume we have consolidated inventory figure of 100. We also have 10 as provision for unrealized profit. The PUP will reduce the consolidated inventory by 10, giving rise to a carrying amount of 90. Now let's turn to the tax base. The tax base will remain the same at 100 because in the individual financial statements we do not consider provision for unrealized profit. This difference in the accounting treatment regarding PUP will give rise to the deferred tax. This difference in the accounting treatment giving rise to PUP will give rise to 100 million. Because the carrying amount of an asset is lower than the tax base. This will result into a DT asset, deferred tax asset, i.e. it is going to reduce the tax expenses. In other words, you're going to be debiting the deferred tax asset and crediting the tax expense in the year. Now, let's look at the cash flow statement, and it can't be any simpler than this whenever you see an increase in the inventories after adjusting for movements as a result of the acquisition and disposal of subsidiary during the year. It's a cash inflow. The decrease, on the other hand, will indicate a cash outflow. For example, if the opening inventory is 10 million and the closing inventory is 15 million, it represents the purchase of inventories. So there you have it. Pause the video and enjoy the summary on one slide. I hope you learned something. And until next time, you take care of your good self.